Hello. All right, we're going to go straight into the first question. I'm here with Carmen. What is with all the chocolate? It is everywhere. It's on your jumper, your socks, your shoes. The emoji is everywhere. What's that about? Where's that from?
It's a very, very good question. And I actually ask every founder, where does your name come from? Because the story is always very telling. To be honest, so it's interesting because the name, I was in Barcelona starting Cocoa, and it just literally came to be Cocoa. And it was COVID and we were staying in Barcelona for a bit, and I ran to my husband and I was like, Cocoa. And he was like, I love it. And then I went to the chocolate store and bought chocolate for an LP who was going to commit to Cocoa. And it was a really fancy chocolate store in Barcelona. And when I was paying at the counter, they had the phases of making chocolate as decoration. Oh. And I looked at it and I was like, wait, Cocoa? This is like seed, Series A, Series B, Series C. Yeah. And so then I always say cocoa is a seed of chocolate, and from the cocoa beans to the chocolate bar, there are many stages, in the life of a startup. What's funny about this, though, is that it wasn't intentional whatsoever. I love brands, and I realized, it has an emoji, people like chocolate, you can do a lot with it. Yeah. So, but I was a very weird kid. I'm a weird sort of taste. I don't like sweets, never, except chocolate. All my life, I've eaten insane amounts of chocolate. And so it's funny how it wasn't because of that, but it's just comes together so nicely. Yeah. And now it's the perfect combo because I get to gift chocolate. I personalize chocolate.
There's so many brand options open, right?
I mean, insane. We do chocolate tasting events. We take founders to chocolate making events. Nice. And the beauty in a world that is so polarizing and controversial is most people love chocolate and it brings a smile. It's also a light, naive kind of smile to it. Also, nobody really hates chocolate. They might not love chocolate, but they don't hate it. And so you can do so much with it. It's infinite.
Yeah, it's great. It's such a powerful brand image. You're right. There's no negative connotations at all.
Which is important these days.
For sure. And so let's go into the wider fun thesis around Cocoa then. Some of the things I've been researching, one of the phrases is backing killers with a heart, backing killer with a heart.
Yeah, I have this here.
Yeah, again, you're decked out. What does that mean? What does it mean? What is a killer with a heart?
That is such a good question because it's so core to Cocoa, right? It's taken me a long time to define. I think I came in to realize certain people were killers with a heart, and that phrase basically is born to define certain founders that I was lucky to back. But then to distill what makes a killer with a heart is always still a work in progress because I keep learning, new things. I think as of today, what I know a killer with a heart is brilliant, beast, with a right to a secret, building because it's inevitable to them. And I will explain. One of the learnings I've had throughout all these years in venture is that building a venture-backed company that achieves venture returns is excruciatingly hard. Yes. It is probably one of the hardest things somebody can choose to do voluntarily, right? And it requires on top of insane amount of good luck, insane amount of work, it requires a very special, unique kind of person in terms of the things that come together in that person. And the first one is you got to be brilliant. It's it's brilliant means IQ, but brilliant means EQ, right? And that's very important. Then you have to be a beast. Because, and this goes to the killer, heart is important and life is too short to live without a heart, but you got to be a killer because the war and the mission that you're on requires fight. Yeah. And a beast is a hustler, an execution machine, but a beast is also somebody with a strong character, who walks firm on the ground. There's so many components to being an animal, basically, as we define it. And it's a hard one to detect though, because when you have an animal in front of you, you can see, but there are many people that have these animal bits to them, but that haven't sort of unleashed them. Yeah. And I discuss this a lot with founders, you got to unleash the beast. And we have this sentence, and there's even a song from Johnny Cash that is The Beast in Me that I send to founders, for some important meanings. But it's true that unleashing the beast requires certain context, and maybe that context didn't happen. And so I think that that's the other bit. And the third one, and this one is less, I think most investors would agree that you got to be brilliant and you got to be a beast.
Yeah.
I think the third one is very much me or Cocoa, in the sense that I am very focused on, I don't do much work on the market per se because I invest so early. I think it's about the founder, but it's also about the founder and the fit with what they're building, right? And this is where the right to a secret comes to play. It's like, I want you to have an insight, to be aware of the bet that you're making, and that insight cannot be obvious. Because if you've detected an obvious problem, you're thinking about it in terms of an obvious solution, right? Everybody, we're in a world in which capital is a commodity and execution is getting commoditized. So whatever's obvious,
It's going to get done
by multiple people, and they're all going to raise money, right? And so it's like, you got to have a secret, and by secret I mean something that either others don't know yet or don't agree with, right? And it might be because of professional experience, it might be because of personal experience, it might be because of many things, but there needs to be something that you know that others don't know or others don't agree with. And then it's the job of the investor to decide, do I want to make that bet? Do I want to join you in that sort of, do I believe in that secret? Do I believe that secret will lead somewhere? And then the fourth one, which is the hardest one to identify before working with a founder as part of the cap table, is this idea of inevitable. And to me, inevitable basically means that as a founder, you don't see a world in which you don't build this company.
Yeah.
And the reason goes back to the point on, this is going to be so hard. And I think actually founders hear it and they hear us saying it's so hard, but it's very hard to actually understand how hard it is up until you're there. And it is also very hard because it makes no sense. Like if you think about it, and I think that's being distorted today, and it's tricky because many people are becoming or launching companies raising money under their wrong expectations, is that being a founder of a startup makes no financial sense whatsoever. Like your adjusted probability is like weighted probability is so low that actually it makes no sense. It makes no sense physically. Like founders I work with gain weight, lose weight, like because it's just brutal, like, right? And it makes no sense emotionally because the level of sacrifices that you're going to have to do with your family, with your friends for this company are insane. And so you have to be powered by an irrational force that means you never ask yourself, why are you doing this? Because the moment you ask yourself, why am I doing this? And you don't have an answer, it's game over because you can't find the energy, right? And so, but that's very difficult to test as an investor because the reality is that every founder I meet is a very smart person who's done their own sort of analysis, who believes they want to be founder and they believe in it for good reasons and honestly. But then 3 years down the line, you wake up one day and you ask yourself, why? Why am I doing this? And you can't, and we even make caps with this inevitable, like, and it all comes actually from me and Coco, like that word, I'm big on the right word, which is funny given that I'm from Spain, don't speak necessarily great English and have a big accent, but I think words matter and there are words that can just sum up so much. And when I had Cocoa 2 fully raised, I looked back and I was like, how in the world did I manage this? And not how did I manage this intellectually, but how in the world did I just, because I remember this times I spent so much time in the US and I would be in this airport in the middle of literally nowhere, right? By myself, like super late at night, nobody to call, like for anything, getting these emails that was like, you know, rejections or like a company doing great, a company not doing great, which is like, and I was like, how did I then, you know, go home, go sleep, wake up the following morning and keep the energy? And I realized that I had never asked myself that question. And because to me, there's genuinely no world in which I don't build Cocoa. It actually makes me feel sick. And I don't know why, by the way. So I don't know why. It was just the other thing but it's inevitable.
You just have to do it.
I have to, like, I always use this sort of framework, or maybe for Cocoa and everything, but I'm very sort of opportunity cost driven.
Yeah.
And I always use this framework, which is like, okay, if 10 years from now, you know, I look back and let's use this example, and I haven't done Cocoa. I'm like, I won't forgive myself Like, no way. Like, I rather live with failure than with regret.
Yeah.
And this is me, that this doesn't mean it has to be right? But this is something I realize about myself. I don't know why. I have absolutely no clue why, And so it's hard to, because even myself took me 3 years to realize that about me and Cocoa, right? And so like, how do you, as an investor,
Find like founders,
and founders, by the way, might not know, right? And so, but it is required, because if not, you just quit. Like, you go do something else.
A lot of the things that you've talked about has been like an inside VC, an angel, a VC turned angel. Do you think that makes your relationship with founders fundamentally different to perhaps other VCs?
I think so. I don't think better. I think different is the right word. And that was my first insight. And the sort of origin of Cocoa comes from that insight. That because I'm small, right? Mainly because I'm small. And then also because being small, I have been a VC. And so I know how VC works. And VC is a game. And I know how to play that game. And also I know every player in that game, right? And how they think I can add a specific value. But the relationship per se comes because I'm small and because I have EQ. Which are, by the way, the two fundamental pillars of Cocoa is the power of small and the power of EQ.
And let's focus on small for the moment, right? Because you just raised, Cocoa number 2, I think it's $23 million. And I've seen you write about the advantages and the disadvantages of being small. A disadvantage being more capital constrained, and it's just a smaller team, less money. There's challenges there, and some of the advantages are actually. I guess I'd ask you, like, why have you decided to stay small, and then how big can small get?
Brilliant. And by the way, this is the question I get over and over again, because I think the biggest risk, let's say the market or LPs like seeing Cocoa, is that and I'm going to quote some of these LPs, and give into the gravity of raising larger funds. And my answer always is, let's see, like maybe in 10 years, we have another podcast and you're full of BS, and like you told me you're not going to grow, and now you have a big fund. Obviously, like, never say never. My take, though, is that what I know to be true is that Cocoa sees the opportunities it sees. It can invest in the founders, can build a relationship, it can build and can work with other investors in the ecosystem the way it does, because it's small. If I am big, and I will explain what small actually means, like if I am big, that breaks. It's impossible. Because, and by small, I mean small in size, which allows to have small ownership stake, right? And the reason these things are in parallel is because the math of venture, a lot of the funds think about it to simplify and generalize, but it's a useful way to look at it in terms of fund returners, right? So every time you're in front of a company, you think about, can this company be a fund returner? That means, can I make as much money as the size of my fund, right? If I'm a $100 million fund and I own 10% at exit, a company needs to be $1 billion to be a fund returner, and me make 100 million. Okay. If I own 1% at exit, the same company needs to be $10 billion. And it's less probable that a company is $10 billion than $1 billion, right? Let's now think about a $500 million fund, which is not off the charts today. If you own 1% at exit, you need to believe a company can be $50 billion to be a fund returner. You can't bet your fund, and you need at least 3, right? Fund returners, or 3 times your fund on $50 billion outcomes. Because if they come, phenomenal, but you can't bet on happening, right? Okay, so the whole obsession of the industry is to bring down that fund returner threshold, because you increase the probability. This is why we've been raised in the culture of stake. Like, all I was taught when I joined venture in January 2016 as an associate, from there till I started Cocoa, it was stakes, what matters. Okay, and so imagine me in 2020, when after angel investing in a few companies and realizing, wait, like, I can build this amazing relationship with founders, I can collaborate, not compete with my co-investors, my friends. This means I get the best access in the companies. I want to do this. And then I literally was like, how? Because all I need is to be small in the cap table. But all I've been taught is you got to have big ownership.
Okay.
And so I love that fund returner equation, because that's the moment I realized it is I had a remarkable, I like to write stuff actually on paper, I left out remarkable, and I wrote fund returner equals fund size divided by ownership stake at exit. And I was like, wait, stake matters and math is math. And I'm not one to challenge math, but it's relative to fund size.
Yeah.
So if you keep the fund size small, this means that you can have small ownership stakes in absolute terms that allow you to be the in-house VC for the founder, collaborate, not compete, but that are high in relative terms to your fund size. And therefore your math works. Yeah. And so if you think about the equation, this, by the way, with Cocoa 2, far more obvious with LPs. With Cocoa 1, they thought I was on drugs. Like, I had this slide that explained very clearly 5% is to a $20 million fund, what 25% is to a $100 million fund. Yeah. And you would never expect a $100 million fund to have 25% at entry, right?
Yeah.
Like that's, and so 5% is neither high nor low. It depends how big is the fund size.
Yeah.
And this is the insight from a fund economics perspective behind Cocoa that allows me to then do what I want to do and invest the way I want to invest. Now, to your point on trade-offs, there are big trade-offs to choosing to keep the fund size small, right? But I believe that the upside outweighs those trade-offs, and I have a healthy relationship with those trade-offs because I chose those trade-offs. Yeah. And so I think that there is a chance that I managed to stay small just because I see the power and I know the trade-offs. Yeah. But they're hard trade-offs. And then so that's how I kind of think about it. Now, to your point, what is small? I think that that's a market question. Because if rounds, I'm making this up, but like in 10 years from now, pre-seed rounds are 20 million, right? Well, small changes because the limit though, so your indication is the fund returner threshold. Like the fund returner threshold needs to be it needs to be achievable. So I don't think of, okay, I'm gonna make up these numbers, but let's say that today the average pre-seed round is 2 million. And Cocoa's check is 500K on average. So that is like Cocoa's is 25% of the round. Okay, if we move on to pre-seeds that are 10 million and Cocoa needs to be 25%, or Cocoa is generally 25%, that is 2.5 million. I don't look at it like that. How I look at it is I want my fund returner to be $1 to $2 billion. Mm-hmm. That is the fund returners I am shooting for. And so I will back solve to that, right? Yeah. Now, what will change is maybe the equivalent to $1 to $2 billion is now $5 billion.
Yeah.
When that changes, then I can adapt the fund size to adapt my check size. But I don't do I need a bigger check, therefore I need a bigger fund, because if the outcomes are not larger and 1 billion is still 1 billion, except in likelihood, I break the model.
So the fund size will increase in line with the market.
But with the outcomes, with the round sizes. Yeah. Because if you do it with the round size, you get trapped into this idea that your fund returner, because your round size increases, so you want a bigger check, but you need to have the same number of companies because of diversification, so your fund size is bigger. And then if your fund size is bigger and you have the same sort of ticket size in proportion, so the same stake, by definition, fund size divided by ownership stake, it means your fund returner threshold goes up.
Yeah, okay.
And it might be that in 10 years, we've seen so many $1 trillion companies. It might be, right? And then, correct. But like right now, to me, what is a likely or a fund returner where I'm comfortable is $1 to $2 billion. Yeah. I don't want the fund returner to be $10 billion. Yeah. And that's how I think about being small, is like when you can have fund returner thresholds of $1 to $2 billion with the check size that you're investing.
Got it. And one of the things that you mentioned is being collaborative with other VCs, especially the larger players. I guess it means that you can co-invest. Does this create another level or tier of VCs where do you find yourself competing with other smaller VCs who are all trying to go after these small checks?
This is such a great question, and I get it a lot, and the answer actually is no. Yeah. In theory, when you look at the market, the answer should be yes. I think it's definitely a problem for small funds in the US. And that's why I also got that question a lot, because what's happening in the US is there's so many small funds that they're actually struggling to get their allocation. I think people are getting in, but then the follow-on question is how much of your check size are you actually getting in, right? Yeah, okay. And if you aim for 300K and you're getting 100K, yes, you're getting in, but like
it's not enough. Yeah.
And so I got that question a lot. The reality, if you look at Cocoa's check size, Cocoa's check size has increased since Cocoa One was modeled thinking 150 to 200K, because the whole idea came from me investing $50K checks and as an angel, and I thought that anything above 200K would add friction. We realized fairly quickly that that wasn't the case, that we could deploy much more.
Yeah.
And so now Cocoa 2 average check size is 500K, and I have up to 800K. So, but I think that in Europe, it will probably get competitive. I do think, though, that if you look at the number of rounds, like, it's still not so competitive that I need to fight you off. In fact, if anything, we continue to collaborate and we bring each other on.
That's nice.
on board, because the rounds are getting bigger as well. And some of these micro funds also, Cocoa has a big 500K, so a substantial check for that. But like many do 150K. So if anything, we bring each other along to complement. And if you want to know my proper view, and some fans are not going to like this, I think we should work much closer together, and we should have a little bit of like, be able to like put together solid rounds very quickly and take them down on the pre-seed. I think that the seed and the Series A becomes, but like the actual pre-seed, like we should work together more. And very quickly in Nigeria, we'll put together great pre-seed rounds for founders.
And are there certain other smaller VCs like yourselves, or certain more established VCs that you like working with? And you don't have to say who they are, but like, what makes a great collaborative fund firm for you?
I think that to me, it's the person within the fund. Obviously, like, there's a question of taste. Different people look at different things in a founder, and there are some humans with whom you have like more overlap, and that obviously facilitates like the actual co-investment. Though I do love to look at companies and founders with people who think very differently than me as well. I think then my main criteria is also, by now, I have enough experience being in cap tables with other funds. And I know that there are certain people in this ecosystem that will just, we're aligned in how we think our role is, how we think of founders, protect founders, fight for founders. And that is very important, because especially for Cocoa being small, you don't want to be in a cap table where you don't agree with how things are being done, and you can't do anything about it because you're small, right? Like, it's very important to be self-aware. And so I think that I love to co-invest with people who I know. Like the cap table is like safe, protected, and power. And then also with people who you have fun with. Like we do it for the fun, and I'm very lucky that there are lots of investors in Europe with whom I would invest day after day all the time.
Amazing. And linked to this, one of the things that I saw that you'd written is that proprietary deal flow is dead. The war is not to see, the war is to win. How does Cocoa win deals?
Luckily, Cocoa doesn't have to win deals related to your brain, but it's a very good question, because I think it is at the core of Cocoa One thesis, and the market has only got more difficult on that front. But if you think about it, to me, venture is a business of access. And this goes back to the point that it is so hard, to build or to get to like a venture, like return company. So hard, so unlikely. And there's so many uncontrollables when you invest at pre-seed, because I invest at pre-seed. There's literally nothing. Like, most of the times the company is not even incorporated, right? Like, and so the amount of uncontrollables that you are the company is gonna face are so much that then my question is like, okay, how do I increase my odds?
Yeah.
So I increase my odds by investing in the, top 0.001%. We can discuss that, what percentage that is, but basically in like the absolute top. Okay. And then the follow-up question is like, how do you invest in the top 1%? And that was my insight when I was angel investing. And at the same time, I was like a partner in a large fund. It's like the beauty when your check size is small, it's that, and your ownership stake is small, is that it's neither you nor I. It can be both of us.
Yeah, okay.
Versus if I need 15% of a company, it's you or I. Like, because if you need 15 and I need 15 and dilution is 20, not going to work.
Yeah.
Now, if you need 10 and I need 5, it can work. And so the Cocoa is whole built on not having to win in terms of value to fight. Now, there's true that you still need to like win over the founder, right? Because they need to choose you, and the best founders have like choice. And so there, my mechanism, and that was one of the biggest learnings Cocoa very early on, is like, I have to be there very, very early. And I have to be there very, very early for two reasons: to be able to win and to be able to assess. Okay. One, in Cocoa 1, January 2022. Our first investment is February 2022. We got the license in January 2022. So very first investment that we looked at being able to actually invest. It was a company, Shopify for, this is going to bring PTSD, Shopify for Web3, backed by Sequoia, US team. Imagine, like, you know, we had just launched
first deal.
I mean, imagine, like, and they had signed in December, so like Cocoa wasn't actually like able to look at it back then, but we met them in January, and they were doing allocation for angels. And my husband was spending insane amounts of time and money in NFTs back then, and he had this very bad didn't return anything, but and he had this insane wallet. Crypto wallet, amazing, super cool. And so I was using that also to like, you know, vibe with the founders, everything. And we had this amazing chat, and they just on the spot is like, yeah, we like, you know, we'll give you like an allocation. Over the moon. Like, you know, this is access. This is the definition of access. Okay. Then they went MIA for 2 weeks, something, or like a week, or rather a long time. And I came back and they're like, well, so, you know, we kind of over allocated. So basically they gave an allocation to everybody, and we have to like, you know, cut down. And that was my realization that Cocoa doesn't sell money. Like nobody is going to talk to me for my back then 150K check, now 500K check. No top founder, no top investor is going to talk to me for that. What I build is trust with founders, and I collaborate with investors. I build reciprocity with them. And if you want to build trust with founders and you want to build reciprocity with investors, you have to be there very, very early. And so Cocoa's whole sourcing machine, Cocoa's whole operating system, which I built myself on Notion, like I was fed up with the CRMs and everything. I built Drive, Task Manager, CRM, everything on Notion. It's because we got to be there first, because if not, you don't build trust, you don't build reciprocity. Cocoa doesn't have a product, right? That's one. And the other one, which has become increasingly more important, is that in today's world, my biggest question, one of my biggest questions is, what is actually value? Like, I'm highly confused, right? I think it's an exciting time, but it's such a confusing time because what we knew to be true in terms of value and how long it took to build has blown up. And so now the question is like, what is value? And is like what we're seeing now real value or not? And is value what we always thought it was? But we are not going to know for a few years. And we got to play now, right? And so my sort of reaction to that is like, okay, I'm going to go back to what I know to be 100% true, which is very few people in the world can build a multi-billion-dollar company. It's about the founder, and that's what I can assess. Okay, but then you need time. Because going back to my point, seeing if somebody is brilliant or not, we can assess fairly quickly. But seeing if somebody is a beast, if somebody is building because it's inevitable, that requires time. Yeah. And so you need to be there early, ideally, like before they've even left their current job. Because that way gives me perspective to make an informed assessment. I can't make an assessment in a week.
And how do you find people like that? Like, what's the sourcing mechanism to find these people who are everything?
So age, basically. So it's beautifully at Cocoa 2, the founder and operator network is starting to compound. At the end of the day, like I always say, venture is network, muscle, and hustle, right? And the hustle powers the network, and the muscle is just learnings.
Yeah.
And by a matter of time gone by, that's starting to compound. And Cocoa founders, so Cocoa 2 has now 8 investments, 5 come from Cocoa's network. And Cocoa's network includes my network and the founders of Cocoa. That wasn't the case in Cocoa 1, right? Like that compounds.
Yeah.
And most of them I had met, like, one I had met 7 years ago, the other one I had met 3 years ago, the other one a year ago, like, and so that's pure compounding effort. That's one. the other one is, so I obviously look at all this LinkedIn, lists and stuff because we got to look at it. But the one that I am enjoying a lot and not systematizing, but enjoying a lot is X. It's a great source. Because also so many founders are building now in the public.
Yeah,
right?
yeah.
And so the thing with that is like you need to think, all right, that's one of my Christmas sort of tasks is how do you systematize it? Because right now it's me going through rabbit holes on a Saturday, on X. And then like other Saturday, I won't do that because I have other things to do. And so it's like, how do you make sure that you cover the universe? Which is always like a tricky answer. But I think that those are the two places where I'm getting the highest quality. And then of course there's the commodity, which is all this like, harmonic and WhatsApp lists that like are like
everyone's shared and everyone's.
So I'm going to tell you something that's funny, but I track everything. When I was very little, I was like 6 years old, 7 years old, and it was my first school day, and I memorized my its schedule, like the timetable. I memorized it all. And I went to my grandfather, and I, started Monday 8 a.m. and finished like 5 p.m. on Friday. In Spain, you do school till 5 p.m. And he told me, he looked at me, and he was like, "What a big waste of time." He's like, "Why did you memorize it if you had it on paper?" And I was like, huh. And so I think that we process so much information that I don't want to have to retain it in my head. Yeah. And so I put everything on my Notion. And I track, every time that somebody sends them to me, I assign this person, this profile, this company, and I say mention by. Okay. Because then also I can thank the people. And kid you not that there are so many forwards from different funds that I get that are the same, with the same writing. So basically fund one will send me, somebody in fund one will send me one of those restos things.
Yeah.
And then another fund will send me the same, and it's exactly the same.
What?
Yeah, it's on the same profiles. It's actually the same sentences.
What?
But this is normal. This is because associates will trade information because our industry is trade information. And so probably one originates it, sends it to you, and then you send it to others because we don't even, bother into changing.
And they're just trying to build goodwill or something? Is that what it is? Just to share information and... Interesting. Okay.
Which again, it's not bad, but it just shows how the moment in which you get the same thing from different sources,
not useful anymore.
It just shows that it definitely it's a commodity. But you still need to look at it, right? And I do. But when it comes, the things that energize me are deal flow from founders and Cocoa's network and deal flow from X.
Yeah, okay. And so going back to the quote where you said the war is to win, and you're not having to win the deals, but win allocation. Why do you lose if you lose? What is it the founders aren't interested in that you're offering?
Yes. So the main reason I lose is because I'm not there early enough. Because by then, founders might not be interested in Cocoa's product. The main reason I lose is because I don't get to see them. And so my main problem actually is not so much if I get in front of a founder, my conversion rate is very, very high, because the reality is that even if they don't think they need it, being a founder is such a lonely job, and you can be the best at what you do and really not understand how venture works at that moment, and also not have somebody that you can talk to. So that works. My main problem is, and I think a lot about this, how do I make Cocoa's proposition to founders being founders to want it even before they know they need it, right?
Okay.
And if somebody makes the warm intro, that's very easy. But when I reach out a lot cold, outbound on LinkedIn, right? And some people react very positively, and I think other founders don't connect with that proposition. I think that's where I lose. If I get in front of them early enough, I generally manage to.
Why do you think that is? What is it about you or your personality that means that when you are face to face with a founder, they're this is somebody I want?
The chocolate. No, I don't think it's so much my personality as it is the real. I mean, I guess getting along with somebody and getting energized by somebody is important both ways. I honestly think is that the gap in the cap table for somebody the size of an angel, which means totally aligning incentives with you, neutral, independent, agnostic, but who understands venture and who knows everybody in venture and who is full-time and full life, basically, is a consistent need. Because the thing that is not maybe outspoken sometimes, and that I understand why like some founders don't want to like sort of make a thing about it, but being a founder is an extremely lonely job. It's so lonely because you think about it, you're in that cap table, okay, there's challenges every day, right? You can't go to your board and try to figure out how to solve it. You can go to your board to help, like for them to help you execute on a solution and to support you. But you don't go to your board to tell them you're clueless, because these people just gave you big amounts of money, right? Like, and they're supposed, like they gave them to you because you're supposed to know what to do with them. But the reality is you have majority of times no clue. That's one. Then you can't go to your employees because they depend on you. Right.
Yeah, and like for leadership. Yeah.
Who do you freak out with? Really? Yeah. Like, who do you freak out with? And you can't go to your family and friends don't understand. And that's a reality. It's like they'll support you. They'll go to the end of the world, but they don't understand. And even your husband or your wife, like, they are going to tell you what they think you want to know because they want to help. And this is also not like always so helpful. And it's from my own experience. Like, I mean, I am the luckiest person with my husband, but like he's many times, I'm like, this is not objective. Like, there's no.
They're your cheerleader, right?
Exactly. They're your cheerleader. And there's too many emotions there and too much sort of emotional investment in there. And so who do you go to? It's a very, very lonely place. Yeah. And so I think that when somebody actually sort of puts that out there and says, I know how this game works, we've played it a million times, I can see it playing out like in the distance, and I know everybody. I think that actually is the product more than just me. Of course, the product suits me and my personality, but I think it is like, that is a needed product.
Yeah, so it's having somebody who is not big enough to
be scary,
but is willing to fight for you and be in your corner and to support you.
And I don't follow on, for example, which is a big part of that. Yeah. And that also means the hit you take as a founder is the hit I take. Yeah. And so I'm by definition on your corner.
Yeah. And is that why you don't follow on? Is it strategic?
So there are two. That is one reason why I don't follow on, because if one of my biggest values is obviously helping also founders with the next round, and even with the mess in between rounds, if you know that you don't need that person, that there's no signaling attached to that person, you can just be so much more kind of open. That's one. And also the math. To me, and this is highly controversial, by the way, I've had this discussion with so many LPs who believe that you should follow on. And there are many people who think, and that's the sort of traditional fund theory, that if you don't follow on, you leave money on the table.
Yeah.
My answer, from the perspective of a small fund at pre-seed, because I think stage and size matters, is, well, yes, if that's the winner. Yeah. But there's a big if that assuming I'm going to hit the winner, right? And the reality is that from Cocoa's perspective, because I'm so small, I would only realistically be able to follow on the next round. Yeah. Not on any other, right? And so that is with 12, well, let's say today, 6 to 18 months. Okay, if I am honest with myself, I don't think I'm a better picker. 6 to 18 months. Versus at the point of first investment, not because of course I have more information, sure, but the number of uncontrollables that can still happen exceed.
Yeah.
And also then the price is multiple times higher, right? So for me, the risk-adjusted return doesn't work. And then the reality is that, and this goes the beauty of not needing ownership stake per se, is that I don't have to protect my ownership stake. If I have to return a monster of an $800 million fund, I have to follow on for sure because I have to protect every percentage of that. But as Cocoa, I don't, because I'm operating under the assumption I get 1% at exit, right? And so from a risk-adjusted return, I'm much better off buying a new investment, like a new chip or a new bullet, a new investment, then following on another one. Yeah. Because like I'm not a better picker.
Yeah, okay, that's interesting. I want to get into Fund 1 and Fund 2, right? So you raised Fund 1, I said beginning of 2022, you started deploying it, 2022, sorry. You've just closed, started deploying Fund 2. Can we talk about Fund 1 first? So like, what are some of the big winners from that fund? And then I also want to talk about some of maybe the big misses that you didn't go into, and then also kind of lessons learned. So to start with, who are some of the standout names from Fund 1?
Yes. some of the best companies. This is again still subjective, and it's not necessarily always corresponding with follow-ons. So we have lots of follow-ons also from top funds. But when I look at like the potential kind of breakthroughs of the companies that I know well, to me, there's Foresight Data Machines, and which is optimization of steel making. I've been, I'm going to confess, completely obsessed with the company and the founder since February 2022. I'm very glad that the market and now the investor community is starting to validate my obsession, because if not, I think I myself was going to start getting a bit concerned. I remember doing fundraising. It was really fun because a lot of LPs would ask me to present the companies that I felt were most representative and strongest of Cocoa One. And I consistently, because of stage and visibility, was presenting Foresight Data Machines and Fractal, which is semis for inference. And I vividly remember one meeting with an LP who I respect, love, but they didn't come in, obviously. And he literally looked at me and was like, "Why did you do that?" Right? Not like, "Oh, wow," as in like, "Why did you just throw down the toilet this opportunity?" And I was like, they are the best companies. And he said, but they don't have the highest multiple, which is correct. And one of them knows, but they didn't back then. And I was like, but I believe that when I look at like uniqueness and potential and the founders and the behavior, those are the two kind of potential breakthroughs as of the information I have now. He looked at me like, what the hell? But thankfully, like the sort of world's coming. That way, I think Foresight Data Machines and Fractal, and probably also a company called Speckle Systems that is like design infrastructures that are open source. They basically bring interoperability to CAD softwares, and BIM, they allow interoperability, real-time automation, and collaboration. And those three companies, when you look at the founders, they're in the building because it's completely, they're like animals, like brilliant beasts, building because it's inevitable to them. They have a secret they're very clear in articulating, right? And very little competition. I think Fractal, maybe with semis for inference, the overall market is competitive. Their approach is quite unique. But I will always remember, for example, with Walter, investing in semis, like my memo actually concluded saying this investment is crazy but not stupid.
Yeah.
Like literally, like crazy but not stupid. And he could articulate so well in what world he won, like what needs to happen, right? What was the list of it? And this is something I spend lots of time with founders trying to understand. It's like, describe me your future. Like, take me to this future in which you actually win, right? Because if things don't change, sorry to disappoint you, but this is not big. Yeah, exactly, right? And so I remember Walter being like, first of all, inference will be bigger than training. Okay, that now we are getting that 2 years ago, 2 years ago, that wasn't obvious. Second, NVIDIA is structurally, like GPUs are not structurally built to win in inference, because the memory and the processor is separated. So lots of energy and compute gets wasted there. Okay. Third, the solution is to do in-memory compute. And then you just go from very macro to very micro. And I was like, wow.
Yeah, okay.
Like this guy is like shooting into the future, but his view of the future is so clear. Now, it might be right or wrong then, but
there's a very clear trajectory and a path.
And you can bet on that. Then you decide if you bet on that and if you bet on this person executing on those bets, right? And the same with Thomas from Foresight, like optimization for steel making. Like Thomas is a guy was PhD in physics and AI. This is February 2022. It's so interesting because I write memos because I just love to go back also like in years. And I remember writing there, oh, it's so unique to be PhD in physics and AI because AI pre-ChatGPT and the physical world were just not vibing, right? They were not matching. And this is a person who, when Russia invaded the Ukraine, the energy prices in Europe, as I remember, just spiked. And a lot of the steel factories, steel plants closed down because it just made no sense to keep the lights on. And so Thomas convinced one steel plant in Hamburg to let him turn it on from 1 a.m. to 5 a.m. And he moved with 3 engineers, right? And they built the product from 1 a.m. to 5 a.m. in Hamburg. I kept sending them chocolate because I was like, they're gonna get depressed. But like, that is the thing. It's like, I don't care, like, words or not, like, I'm gonna build this company and I'm just gonna find a way. And it's not because they're it's because they're just powered by this irrational kind of power force, right? So I think that those three are very, like, they're killers with a heart. They're building unique products in very big markets. Like, and then in early stages, also Cocoa has like many interesting Cocoa One bets that are still like pre-seed. So there's Stylebox that does like data infrastructure for satellites data. So that's really, really cool. There is Embed, which is a company that basically does software hardware integration, which has gone through a lot as well. Like, there are 3 Ukrainian founders, one in Ukraine with a 3-year-old, one in Berlin as a refugee with a 6-month-old, and one here in London. And look at this. They tried to raise November 2022, and they had a term sheet. I met them for the first time then. I didn't understand what they did, like, at all. And also, there was this term sheet, and you asked me earlier about investors who I love to invest, and I would never interfere in the cap table building of a company, but there's certain people I rather don't be on a cap table with because I can't, do, like, or protect the cap table. And so I decided, I don't understand what they're doing. I'm not, like, a huge fan of the investor, done. But I remember them. And so in May, I pinged him and I was like, hey, how are things? And so we went for a walk. And he told me that they actually, and I had made no comment about that investor, so it wasn't like, it was their own sort of intuition. They rejected that term sheet and they bootstrapped it till May. One in Ukraine with a 3-year-old, and then the other one in Berlin, and the other one here. I'm like, wait, what? And he was like, yeah, because, this is our company, this is our life. Yeah. And of course, having money would totally help, but it needs to be with the right partner because this is and this is a difference. It's like when you see founders optimizing for long-term versus short-term. And that's also what fuels them, right? There's this life project, because if it's your life project, you're very careful in every fundraise, how much and with whom, because you don't want to break it, right? And fundraisers can break companies. And so, like, this is a kind of, similar, and again, building in, I take, if you look at Cocoa One portfolio, you can see insane go-to-market risk. I take a lot of go-to-market risk and many times TAM risk. But because what I don't take is founder risk, so to say. Sometimes I'm wrong in my assessment, but like, I don't like founder risk. I don't like to take. And then I just trust that they will figure it out and that they are better than me at identifying market opportunities. Because if I am better than the founders I back at identifying market opportunities, I'm backing the wrong founders.
Yeah.
And so that's a little bit how I think about it.
And what about, what are the misses? Maybe you had an opportunity to invest in some great companies and you missed.
Misses.
And those are the things that like keep you up at night.
Mortify me. I think the biggest miss of Cocoa One and the most defining thing it has made me think so much and change so many things is 11 Labs.
I thought you were going to say that for some reason. Yeah, that's so interesting. And like, what turned you off the company?
So yeah, it's not the company. So it's what did I do wrong? And I realized, actually through 11 Labs and also through fundraising Cocoa too, that many times and inadvertently, I don't think we realize it, but we investors get into this mindset of looking for reasons to not invest rather than reasons to invest. And that's a very dangerous game because if you think about venture, you can afford investing in the wrong company, but you cannot afford missing one of the...
Yeah.
And so actually it's a paradox that we actually get into a mindset of looking for reasons to not invest, i.e. to pass, when that's the riskiest thing that you can do, right? Why do we do that? I felt so much about it. I think that we do it because we have cognitive overload. We're completely overwhelmed by the amount of information being thrown at us, by the speed of how things move, and also in particularly in the case of people running their own funds, by execution. Execution is a trap. Execution is a trap because it gives you the dopamine, but you're not thinking, right? You're getting shit done, and passing becomes a shit. You have almost when you decide to pass on a company, sometimes if you've done a lot of work, it's a painful, excruciating thing, but otherwise it's you feel relief. It's how wrong is that?
Yeah.
But it's because you get it out of your desk.
Yeah.
And that's a very, very dangerous. And so with 11 Labs, it was the week of my wedding. So I was definitely on execution mode. And my mistake, so I remember I passed for reasons. I actually have it framed in my office. I frame lots of stuff in my office. And I have this chat with a friend of mine who's a partner in one of the top seed funds in Europe. And we were talking about 11 Labs. And we both sound so smart. Unbelievable. Like, I talk about go-to-market, he talks about competition. And it's just like, and you look at it, it's like, here are two morons looking for reasons to not invest. Because at pre-seed, passing because of go-to-market is just, and like who? Like me, who passed me? Like, and back then they were doing dubbing for creators, so completely different, right? But 6 months after, there was ChatGPT. And that changed everything. And it's not that ChatGPT made them, it's the founder's ability to leverage that made them. And so my investment decision was wrong because I didn't correctly assess the founders. And I went to the go-to-market and I went to the competition, and who cares about that when it's completely unknown and you've got the founder. And likewise, the same applies with the first ever angel investment that I did, which was Hopin.
Yeah.
Like Hopin was an incredible pre-seed investment decision. And it was travel, which everybody hated, like travel plus the events, so and ticketing. But he was incredible at pre-seed. Then COVID came, he leveraged COVID. Then COVID went away, he didn't leverage that. And so it was a bad Series C investment, but it was a great pre-seed.
Amazing, yeah.
But because of the founder, like I could have passed on go-to-market also there. Yeah. I could have passed on TAM for events or whatever. And it's just like, we look for reasons to not invest rather than for reasons to invest. And at Series A, go-to-market is a very valid reason. Mm-hmm. At pre-seed, are you kidding? Like so I have it framed in my office being like, and then now because of in Notion, I have these Deel pages, right? Like, so a page per company. And the cover, Notion allows you to use, is like a Dumbo flying. So to remind me that, to have big ears, and do the work to understand if the founders are potential killers at heart.
No, that's an amazing story. I mean, I can't imagine.
Pains me.
Yeah, but it's good. I think you need those misses, right?
Correct. So, you need those misses to change. I've changed so many things.
Yeah, and that kind of leads on to Fund 2, right? So, Fund 2, deploying it this year, you announced it a few weeks ago. How was that process, and how different was it to raising your second fund versus raising your first fund?
Very, very, very different, and probably in an unexpected way. So Cocoa 1, we raised it Q4 2021. Peak of the market.
Yeah.
Like people were genuinely throwing money at you. We raised 36 million in 6 weeks.
Wow.
And we wanted 15. It was wild. And it wasn't us. It was genuinely, like, I remember vividly, in the pipeline, we would have like somebody estimated check size to 150K, imagine. 10 minutes into the call, 2.5 million. I was like, what? How? Like crazy. It was wild, right? Yeah. Cocoa 2, very different market. Very, very different market. And also, so very different market one. Also, my bets, to your point, are non-consensus, many of them. And the ones that you've asked me, like, who do you really have insane conviction right now? They're non-consensus. And non-consensus also based on that building value takes time. Like building semis for inference is not something that you do in 1 year and go to like, 6 figures or 10 figures, whatever. And so the challenge in venture is that you are playing a game and you aim for levels of value that takes very long time. So you're playing a long-term game because you can't build the value that we need in short term in general, but you raise every 3 years. And so the incentives break a little bit, right? And like it impacts your risk taking. And so I looked at that and I was like, damn, like how do I manage this? Because I want to build an LP base that allows me to take insane long-term value risks, right? And so that's why I decided I wanted to build a very institutional LP base, though I fairly quickly realized I had to go to the US to do so. And Cocoa 2 is a fund that is 93% institutional, 64% US, right? And it has like Sapphire and 3 US endowments. But because I wanted to make sure that I could invest in certain bets in Cocoa 2 that by Cocoa 3 might not have paid off, right?
Yeah.
Or that some, usual suspect multi-stage fund is still not incentivized to take that level of risk. But that I believed in because I believed in the founders and I wanted to be able to do that. And that's how I built Cocoa to LP base. It was not easy and it was not quick, but I'm very happy. I'm very pleased now.
No, amazing. You're already deploying it and, that seems to be going well. I also want to talk about your view of the whole European market. It's interesting to talk about some of the LP base coming from the US. It seems that's the way for pretty much all European funds, it seems. And that's something that I'm really passionate about because it means all the value gets captured ultimately by the US pension funds and endowment funds. But what's your view on the ecosystem more broadly? When you look at European tech, it seems to be having this amazing breakout year, specifically and a lot of optimism and a lot of ambition. But what do you think that we need to do across the ecosystem to take it from where we are today to that next level?
Something I do think about because my mandate and my fiduciary duty is to return the fund, to basically return money to LPs and as much as possible. I said earlier, venture is a business of access. My access is in Europe.
Yeah.
I think I don't kid myself. Every time I meet a founder, I ask myself, why am I seeing this founder? Why would they choose me? Why would co-investors choose me? And if I don't have a strong answer to that, I don't invest, right? And so then the question is okay, how do you play Europe and the US and everything? And this is not necessarily politically correct or popular, but to me, Europe has exceptional raw talent, and by exceptional I mean equally good as US talent, not only technical, just raw talent, pre-everything talent. Now, the US is a much better place to build a business. And the challenge we have here is that the US is a much better place to build a business, and that compounds every day. Because every day that you're building a company in a place that's a better place to build a company, compounds. And so this playbook that we used to have of build in Europe and then go by Series B maybe worked in a world that didn't move so fast and where not everybody could build the same, right? But the idea, how I put it to founders, because I also try to be respectful with life choices, but is, okay, where do you need to build? What do you need to win over? Do you need to win over the US to win? If the answer is yes, it's okay, which is generally in software. From where do you build that right to win? Because I do expect every founder to be wherever they build the strongest right to win.
Yeah.
That's basic.
It's given, yeah.
Exactly. And so the challenge we have in Europe right now is that a lot of the times the answer is in the US, right? And I call this the Great Migration. Mm-hmm. So I spent a lot of time in a lot of time in the US, specifically in San Francisco. And a year and I've been doing so consistently for the last 3.5 years. The March this year, I literally came up with these things this is the Great Migration. I saw so many European founders there. Many of them will come back, but it was incredible, right? Yeah. And I think some for the right reasons, some for the wrong reasons, but the US is a better place to build a business. And so you're okay, how do we make Europe an equally good place to build a business? Because if not, you're always going to be at a disadvantage, right? And there is a combo of many things. I think one of the things that is very interesting in the US, particularly in San Francisco, but is the density of talent that knows how to scale companies. I think that's one. And that is a flywheel that just takes time, and that will take time. But that's something that we need to make sure we foster and preserve, is talent that knows how to scale companies and that has done it a couple of times, because we don't have that in Europe so much. And that's one. The other one is the buyers are much better. They take much more risk. They sign faster. I have companies that started in Europe and the founders have moved to the US because it's just...
They get pulled. Yeah, the market pulls. Yeah.
They in the US, they pay much more. They're much faster in signing. Yeah. It's just... So that's it. And then third, and this is a, cultural kind of thing. I think, this is a personal opinion, but San Francisco has improved a lot in the past year, but this is a city that exemplifies in the most, in the wildest, survival of the fittest, kind of infinite upside, infinite downside.
Yeah.
And I think something happens to you when every day you see infinite upside and infinite downside, because it's different. Like the pool, like when you know where you can end, here or there, like you just, kind of go different. And also, the other kind of way I put it is more things happen in the world when you think everything's possible and you're willing to put money on fire to make it happen, right? So if you think about it, the best example would probably be whenever, we realize we've got ahead of ourselves with AI and like there's sort of a correction. I'm sure in Europe, there'll be plenty of comments focused on how much money has been wasted. For sure, right? Inevitably. We love that. Now, in the US, probably the argument will be like, yes, but we needed to burn all that money to get here. Yeah. Because you do not get here without burning all that money, right? Yeah. And so I think that just more things happen in the world when you think everything's possible and you're just willing to set money on fire for it. And here, we're not willing to set money on fire for it. Yeah. Like, and you see that with the companies and the fund. And then that's why then the Series B, Series C funds come here and like, deploy the money. And that is like, we are going to have to change that. And I don't think public money is going to change that.
Yeah. Well, it's linked to like almost like the risk in the buyer culture as well. There's just such a propensity to hold on to money. And whether it's buying software or investing in great companies, people are just significantly less willing to do it.
Exactly. But because also we probably have less to win.
Yeah, the upside is lower.
And less to lose.
Yeah.
And so what's your incentive? Like when you can win everything and lose everything, like...
It's worth taking a bet maybe. Yeah. Interesting. Well, thank you so much for joining me. I want to finish on some quickfire questions if that's all right.
Of course.
What piece of media, book, podcast, newsletter would you recommend that either a founder or a VC starts listening to as they go into 2026?
I'm a Yankee completely, but I'll actually give a few books. Patent Breakers, incredible. When the wizards stay up late at night, I think it's called, also like the origin of internet and stuff. But Patent Breakers is amazing for founders. And then if you want to understand how VCs think, I think Harry does an amazing job at the 20 VC. But I also particularly enjoy podcasts like Invest Like the Best. I really like those interviews. And I love the Strategy newsletter from Ben Thompson, just because it's analysis. It's not just news. It's like analysis. The Generalist does a great job. Newcomer is great. I am complete young.
You're on them all.
Love it.
And then what is the number one deal that you've been most proud of? It doesn't have to be the best performing, but maybe something where you've played the biggest role in helping, or maybe it was the hardest one to get allocations. Something where you look back on it, and it can be in your whole career. But that's the one that you really think about as, I did that founder proud. That was I played an important role.
The one where I kind of, that has been most defining was Hopin. Yeah. And Hopin was most defining for two very different reasons. But I owe Cocoa to Hopin, as in I would have never have this insight on being able to work with founders this way if I hadn't met Johnny, and I spontaneously would have built that kind of relationship. So that's the very origin of Cocoa, even if I didn't know it back then. And also I didn't sell. So I didn't make any money.
Interesting.
Right? Which was also an incredible learning as well. And obviously lots of people
what a crazy first deal.
250K at 2.5 million post was the pre-seed in 2019. And people are like, oh my God, and I honestly think that if I would have lost, my husband says this is just me making myself feel good about it, but that if I would have sold, I don't know if Cocoa will exist but also I don't know if I would have the same hustle and the same hunger because we're all humans. And I don't know if I would be in Luton at 4 a.m. sitting on the floor on my laptop if I would have sold at the right time. So maybe it's a distorted, dysfunctional way of looking at it, but I'm actually very, very grateful to that company for all the good and all the bad, because it just made so much.
Really defining. Yeah, it's interesting. I spoke to another VC and they said they were investing in a second-time founder who had built a company that was valued to 700 million, and then it almost collapsed. And they said that that brings out the beast in them. When you've had all this money or wealth on paper and then you lose it, the drive that gives you the fire that can light under them. And they said this is an immediate back. If that founder has that fire to get back to it.
Yeah, exactly, because you've touched
to be so close and to see you lose it all.
Yeah, exactly.
That's a great one. And then What advice would you give to somebody who, has followed your career path and is really interested into breaking into VC? What should somebody be doing right now to try and elbow their way in?
I think it's a very difficult time to join venture, very different to like 10 years ago. Yeah. I honestly would give to whoever is like thinking about venture or about any other thing is like, do the work to know yourself, to identify your superpowers, to accept those superpowers, even if they're not the ones that you think that you should have. Like for me, being IQ was a condition of self-worth. And I realized actually it's much more EQ what is unique. Like identify your superpower and build around it and find a job, a career, like a purpose that is around that superpower. Because there's actually talking about posts. There's this beautiful post called Differentiation by the Not So Boring guy. It says, build your own personal monopoly. Like everything else, like if you're going to be average or something, AI can be average, anything can be average. Just like identify what it is and just go hard on it. Yeah. And if it's venture because you're great at networking and you're very analytical, go for that. But if it is like something completely different, just be like, have the courage to take a path that is built around your superpowers. Because if not, like, you're never gonna
stand out.
Yeah. And you're not gonna be fully kind of aligned and connected to it.
And last two questions. If you were given £5 million tomorrow to start a new company, what would you start?
I think this goes back to what I said earlier. Like, I don't see a world in which I don't build cocoa. It's like genuinely impossible. Like when GC acquired La Familia, I got this question a lot and people were like, oh, would you sell cocoa? And I kid you not, like stomach aches. Like, it's just like, why? Like, what? No. And so like it's inconceivable for me. I mean, I'm helping my husband, I'm supporting him build like a mobile dog grooming business and that's really fun and everything. But I can't like, I actually think if I had an answer for that, I would be in trouble. Yeah. Because if there was something else I would want to do, like, I would have a problem. And this is probably for founders, like maybe if we turn it into something productive, to them it's like, because it's a great question, it's like, choose whatever you build, do it because you don't see a world in which you don't build.
Yeah, there's nothing else.
There's nothing else. Because if there's something else, if you have like, oh, I could do this, and if it doesn't work, I can do that, don't do it. It's honestly like too hard.
And then final question, if you had the same amount of money to invest in any private company from as early to as late as you like, what company would it be?
I think the next, I would obviously like their founders like, Thomas or Walter, Thomas from Foresight, Walter from Fractal, who I would put my future in. Yeah. But I think the answer to that is the next investment that Cocoa will make because I am a pre-seed investor. Yeah. Like I don't follow on because I'm not a great picker after. I don't put SPVs up until like very late because I'm not a great Series A investor. I'm not a public stock investor. So it's just the next Cocoa investment. More into
pre-seed. Yeah. Amazing. Well, look, thank you so much for joining me. I've loved it.
This was so much fun. Thank you.